Good morning, ladies and gentlemen. My name is Ryan Suter. I'm one of the senior investment managers here at Sharewise. And we're here this morning with James Storey. Now, James has been kind enough to lend us his time and expertise regarding the 360 Capital Mortgage Real Estate Investment Trust. Obviously, James is the CEO of that one. As usual, we're going to kick things off with a presentation from James, and then we're going to open the floor up to a Q&A. I will kick things off with a couple of questions after the presentation, and then we'll open up the floor to participant questions. So if you'd like to submit a question for me to ask to James, please submit it through using the Q&A function on the Zoom. Now, James, thank you very much for your time this morning, mate. The floor is all yours.
My pleasure. Thank you, Ryan, and thank you for everyone that has joined. I appreciate your interest in the 360 Capital Mortgage REIT. I will just share my presentation. Bear with me 1 second. Just confirm that's up there now, Ryan.
There we go. Can't see it. Thank you.
Excellent. Thank you. So I'll start with a background on 360 Capital Group itself. So we have been around since 2006. That's 18-year track record, investing across both real estate, debt, equity, and a number of corporate transactions. Over the last 8 years, the business has been focused on real estate credit as well as real estate equity. And over that time, we have done around $400 million of transactions, and they've averaged around $15 million. So the segment of the market that we are most focused on is the owner builder, and I guess the middle market investment property type loans, which, as I say, are around that $15 million mark. Over that time, we've averaged an interest rate across that portfolio of just under 11%. So that's been at a time when interest rates have been close to zero, where we were doing more fixed rate type loans, as well as now where the base rate's obviously higher, where we're pricing our loans at a margin over BBSW. And in terms of investor access, we offer both the listed investors access through TCF, which also obviously allows retail investors to gain exposure to our type of loan investments, as well as a wholesale offering through our private credit fund, which is deal-by-deal loan syndication. And that just allows investors that like to choose specific loans the opportunity to access those loans individually. So in this presentation, I'll give an overview, obviously, of the REIT itself, but also just touch on some of the background to the real estate credit market, as well as really real estate private credit as an asset class, given I'm sure most people have seen it in the paper more recently, and obviously well aware of private credit as an asset class generally expanding. So if you look at the real estate capital stack, which every asset comprises of these, generally these components, is obviously the equity, which is really your traditional REIT type investment, or the equity in your house, or the equity in an investment property, and typically the bank senior debt or another senior debt provider. In the investment property space, it's commercial investment property as well as development space, there is also quite often another tranche in there, which is junior debt. So junior debt is another name for mezzanine. It could take the form of a second registered mortgage as a straight mezzanine debt instrument, or be a quasi-equity type investment, which you quite often see in development projects where, as well as a fixed return, there is some element of profit share, and that is called preferred equity. Looking at the senior debt side of the stack, now this is what most people would know as their home loan, or where I guess you would see a lot more of the credit funds playing. So this is a first mortgage position over that real estate asset. So typically, if we're talking about a development project, there'll be the first ranking mortgage that's secured against that development site. And then within that facility, there's the ability for the borrower or the developer to draw an element of the cost to complete and other construction costs or project costs to deliver that construction project. So where does it fit, I guess, and what's the opportunity set? So the real estate credit market in general is about $370 billion. It's commercial real estate debt. We see that continuing to grow as banks and other traditional lenders pull back from what they're prepared to finance. So the loan investments themselves are obviously secured by a real estate asset. So every loan that we do is secured by a first or second registered mortgage against real property. So in the event there is a borrower default, there's the equity buffer there in that capital stack that allows the lender, if something was to go wrong, to step into the equity participant's shoes, sell the asset, and then obviously recover their capital and any interest and fees that are outstanding. So credit, unlike your typical AREIT investment, which requires your tenants to be in place and paying rental income for the distributions to flow through, we obviously receive our income in the form of interest payments. So typically on a construction project, for example, the loans are capitalizing, so you actually don't receive that interest to the end, which, given it's a monthly income-focused vehicle, you'll see as I go through the portfolio of TCF, we focus more on loans that are serviced during the cash flow or during the hold and loan period. So that regular cash payment of interest is obviously what then provides the underlying investors their distribution income. And really coming back to what I spoke about earlier, given you have a registered mortgage on the property, you rank ahead of the equity payers or equity holders. So the lenders get paid first in the event of a default situation or an enforcement scenario. Just touching on the types of loans in the real estate credit space, what a lot of non-banks do is site finance. Now, we as a business have steered clear to date, having only ever done one site loan. Site loans are easy in that all your money is advanced day one, but they are capitalizing loans, so the interest is typically not paid during the life of that loan, and you're also highly leveraged operationally to the real estate cycle. So everyone knows how long it takes to get a development approval through council. So, typically you're talking anywhere between 9 and 15 months in good times. And then during that time period, obviously a lot of things can change in a market. So from a site finance standpoint, you might have gone in at an LVR of 65%, but let's say it takes you longer than you had expected to get the development approval. And if there's then a change to construction pricing or the end value for what you're forecasting to sell your end product for, there's a lot of pressure and risk that gets placed on those site loans. And I think you're seeing a bit of press at the moment around site values and some of the non-bank lenders that might be in positions where the sites were funded at a level, and now over 2 to 3 years that interest is capitalized and the value of the underlying security has deteriorated as costs have increased. That's, I guess, where our focus has been over the last few years, more on residual stock loans, where you're not as leveraged to the construction cycle, given everyone's aware of what has happened during COVID from a delivery standpoint on construction projects. The other types of loans there, we've got investment loans, which are your typical investment properties, be they offices, shopping centres, industrial assets. We actually have a service station in our portfolio. And so they are serviced through the rental income that's received from the underlying tenants, and then the loan is repaid as a bullet repayment at the end of the loan term. Development finance, so this is really, I'd say the focus of non-bank lenders is really the residential construction space, and now be that site finance, development finance, or residual stock and land subdivisions. So this is where you would lend against the construction of, let's say, apartments, for example. So you're funding against the land. You're also funding a portion of the cost to complete that construction project. So there's obviously certain risks in these types of projects over and above just the end value being the market risk. Our focus really is very heavily on the builder due diligence. Now, over the last 3 years, we've only ever done one construction loan. We did a lot pre-COVID, but our focus really has been residual stock for the reason that a lot of builders had quite large back books of work. And as people probably realise, builders often move on from one project to the next and are not always running the most efficient balance sheet model. So we have typically steered clear of the last 3 years, as I say, just given you're taking another level of risk, which is delivery risk, being the builder's ability to actually finish a project. When we do a construction loan, your builder really is the partner in there, which is really why we've focused on that mid-market where they're owner builders, you know, that this project is what they're focused on. They don't have other projects that they're doing on a third-party construction basis. So you also need, in order to get that construction funding, typically from a bank, you need a level of pre-sale coverage, which would be around 100%. Now that's the number of sales or the value of the sales of a project before you actually start construction. The non-bank market is more flexible with that level of pre-sale coverage. So they'll do anything from 0 to 70% debt cover, which is the number of sales really over the debt value. We have really focused as a minimum of 30%, just to know that there is some coverage there from at completion. You can pay down your debt and move to a residual stock loan, as well as proof of concept of the underlying project in that market at those price points. Land subdivisions are very similar to a construction loan, and residual stock really is what we have focused our efforts on over the last few years, given the level of debt cover required by non-banks is lower. So quite often you get to practical completion where they've only sold a small portion of the underlying either apartments, townhouses or houses, which means you need another loan to go and take out that construction facility. So we have done quite a lot of this across both the east coast of Australia and a number of loans in WA as well, where we come in, we finance out the construction lender. So all the titles have been issued, construction is completed, we repay the construction debt, and then we're repaid through ongoing sales of that remaining residual stock. So we typically lend it up to 70% of the current market value, ex GST, and then we pay down our facility through the proceeds of those sales. And at the outset of the loan, we agree with the borrower what portion of the sales are split between the borrower and ourselves. And more often than not, we take 100% of the proceeds to an LVR of say 60%, and then split the proceeds with the borrower from there, typically on a 60-40 basis. So I guess from our perspective, we see those loans as taking, obviously there's market risk, but if you look at our loan book at the moment, 60 cents in the dollar on a brand new house in Sydney, when everyone knows how undersupplied Sydney is from a housing perspective and how hard it is for actually these projects to stack up at the moment, given where construction costs have sit over the last few years. And the last loan type there is mezzanine and junior, which, as I said earlier, is subordinated to the senior debt. You obviously get a higher return for that type of loan, but it also takes on a higher degree of risk, given you really, to some degree, need to wait and see what the senior debt does before you can step in and enforce any of your rights under your loan agreement. So how can it fit into somebody's portfolio? It's really an alternative to fixed income. Obviously, slightly different risk profile to some bond products out there and hybrids, but if you pick senior loans that are secured against high quality real estate, where you're dealing with a manager that's very transparent about what the actual underlying loans are you're exposed to, it can be another way to have regular monthly income or quarterly income in your portfolio. Obviously diversified from equities, so you don't have the same level of volatility that you would have in an equities portfolio, and then also adds capital preservation or an element of capital preservation, given there is that equity buffer over and above your investment. You also have the ability to take higher returning loans if that is in your risk appetite. We have a wholesale offering, as I mentioned earlier, which you can access via our website, where we quite often provide investors with higher returning, whether that's preferred equity or mezzanine investment opportunities, which don't fit within the risk profile of a TCF, which is obviously for more general investors in a pooled fund structure. I'll touch on TCF itself now. So it's one of only two ASX listed mortgage REITs. So there's QRI, which is Qualitas's mortgage REIT, and then TCF. The other LITs out there are all diversified. So quite often they'll include private equity or consumer credit, as well as an allocation to real estate. If you have a look at TCF's results, and I'll talk through the portfolio in detail here, you can see it's purely real estate loans. I'd say, yes, this is a smaller vehicle, but it provides a lot more transparency than some of our peer set in what you're actually invested in. So from a return profile, we're currently paying out a 10.2% forecast FY25 distribution on the trading price. Since we took over this vehicle in 2020, when it was actually a bond fund, we have increased distributions by about 120%. So that's been a combination of the market and higher base rates, as well as that our proprietary deal flow that we have. So we've been in this space for a long time. We've been in real estate equity markets and real estate markets in general for even longer. All our loans we have on our loan book to date are from direct referrals that we have or relationships we have. So we're not competing in the broker market. It's obviously quite a competitive space at the moment for deals, but having those relationships, pricing is a secondary conversation to the certainty and relationship they have with ourselves. NTA is 594 a security. We're trading, I'd say, 2% off NTA at the moment, given it is a small fund. One of the mechanisms we implemented in December of last year, along with a capital raising that we did, was to put in place an off-market buyback facility to provide unit holders with some certainty around liquidity at NAV. So since we've done that, the security price has traded up in line with NTA or NAV, and it provides some comfort there that if you are wanting to reduce your exposure, you can do so through that off-market buyback mechanism. And we've grown the vehicle. So we did a capital raising in December, an $8.9 million placement. And as we foreshadowed in the results, we would look to do an entitlement offer at some point the second half of financial year 25 at NAV. So investors that want to increase their exposure, given it is a relatively small vehicle and relatively illiquid, you can obviously participate through this entitlement offer that we are likely to do in the second half of FY25 at NAV. So target returns 4% over the RBA cash rate. We're obviously exceeding that given the loan book we've got at the moment and the fact that it's a smaller vehicle. Touching on the portfolio itself, LVR is just under 70%. 96% of the portfolio are senior loans. So we do have the ability to do up to 30% mezzanine or junior loans in TCF. However, our focus has really been on keeping that to a minimum of 10%. So at the moment, we have one mezzanine exposure. The balance of the loans are senior and heavily weighted towards the residential sector rather than commercial. And average interest rate at present is around 11.5%. So just touching on, I guess, a case study of one of the loans we had earlier this year, which was a residual stock loan. So this is a developer we do quite a lot with. They're in northwest Sydney. That is actually in Tallawong, which is near Marsden Park, for any of those that are from Sydney. So these were 4 and 5 bedroom houses. They had an average price of 1.2 million ex GST. If you look where we sat, so it was a 70% LVR. We stepped down to a 65% LVR before we released any proceeds to the borrower. In this area, obviously everyone's borrowing from banks at 80%. So, if you compare it to what is a traditional residential mortgage, we're doing loans like that just on a larger scale. So this was 21 houses, so part of a subdivision. We were sitting there with a debt value of $870,000. That obviously improved as sales occurred, given we were sweeping 100% of the proceeds of the first few sales. For that, we received a return of just over 10%, which at the time increased to 10.9 with the base rate increasing. So it was secured not only by a first mortgage on the real estate, but also corporate guarantee by the borrower and personal guarantees by the borrower as well. So we were repaid that loan over a 12-month term, which we were paid in line with those sales. So our security position was improving, and that loan was actually serviced, given the developer has about a 25-year track record and an NPAT of around $50 million. So a pretty substantial developer. I guess some people ask, why do they come to groups like yourselves to borrow money at those sorts of rates? It's certainty. I mean, banks don't typically like these types of loans, given you're taking over the rest of the stock in a project. They have been doing more recently. We are slightly higher up the LVR than a bank would be. A bank would probably do this loan at 60%. We're doing it at 70%, but have other mechanisms in credit enhancements in place. And they want to deal with groups that they know have the capital and have the ability to execute in a relatively quick time frame, which is why they come to the non-bank market. And a lot of developers and even more investors are moving away from bank finance and coming to the non-bank market. So if you look at the loan book as it stands today, we have 5 loans across the portfolio. We have a residual land lot loan in Northwest Sydney, and another 2 residual stock loans, one in Schofields and one in Colby. They're the 2 on the right-hand side. We have a small junior exposure to a waterfront development in Sydney. So if you look from a construction standpoint, you're paying anywhere between $6,000 to $8,000 a square metre to build your typical 2-bedroom apartment in Sydney at the moment. That's excluding land and other costs. If you look at what they sell for, if you said the inner west of Sydney, there's somewhere between $14,000 and $17,000 a square metre. And obviously it's harder to get sales at the moment, given the affordability issues. If you compare that to something that's being built on the water in Sydney, so the construction costs on this project are $14,000 a square metre, but they're being sold for close to between $40,000 and $50,000 a square metre. So there's a larger profit margin in those types of projects, and that's where you're seeing the majority of the construction at the moment happen in that luxury downsizer stock. Now, this loan was obviously too big for us to do the senior loan. We have a good relationship with this developer, so they approached us about doing a smaller junior tranche. So it's a $4 million facility, of which TCF's exposure is limited to $1 million, because obviously there's a higher risk doing these types of loans. So we syndicated the balance of that loan with our wholesale network. So they're getting a return of 18%, whereas the TCF loan itself is a 17% coupon, if you like, or interest rate, with an exit fee payment, which gets it up to a 20% IRR over the loan term. So that's been going now for just under 12 months, with 12 months to go. Construction's in line with schedule. So they're the types of loans that you could get access to through our wholesale network. And the last loan there in TCF's current portfolio is a bridging facility on a service station with a 12-year WALE. So again, the income over our debt value is around our interest rate that we're getting. So we're getting 9% plus on that loan, which for a 70% LVR on a 12-year leased service station in New South Wales, we think is an attractive return for the risk profile. So why invest in TCF? It's a highly attractive yield. It's consistent monthly income, and you see the track record that we have. We've increased distributions by close to 120% since we took over the fund. We obviously benefit from higher rates, and we have rate floors in all of our loans that are based as a margin over BBSW. And I'll also point back to the fact we've been doing this for the last 8 years when rates were 0, and we've still managed to maintain those levels of interest rates over that period of time. Now, that really is because as the market moves, we just move our loans back to fixed rate loans. So I've got a loan in due diligence at the moment. Instead of pricing it as a margin over BBSW, I've just priced it as a fixed rate loan at 12%. You obviously get capital protection by having that equity buffer in front of you. And as you saw in the residual stock loans, there's 30% equity buffer in front of you that would need to fall before, or values in Sydney would need to fall by 30% before our loans in those types of loans are impacted. And there is an emergence of managers out there, which you're seeing at the moment, and you're seeing a lot of press about private credit and real estate private credit in general. I guess when you're choosing a product to invest in, I'd say look at the manager and look at their skill set. So we not only have a real estate credit track record, but real estate equity as well. I've been around for 18 years. I think if you look across the market, a lot of the peer set are I guess, banking or finance backgrounds. We look at this as a real estate investment. It just comes down to where you're playing in the capital stack. So I think manager selection is very key in this part of the market, given it is emerging and it is, I guess, a relatively, I wouldn't say new because it's been around before and there's been failures before in this space, but picking the right manager with the right skill set is key. With that, I might hand back to Ryan and see if there's any questions.
Thank you very much for the presentation, James. Really appreciate it. So I'll kick things off with a couple of questions, and then we've got a couple of questions from registrants. Now, first one I just love to address is realistic. Why do you guys choose to focus on the kind of $2 million to $40 million loans as opposed to ones, that would be much larger?
Because we look at it from two standpoints. One is risk. Obviously, a larger project takes longer and has more complexity, as well as if you're doing loans in that middle market, it's a less competitive space from a pricing standpoint. So you look at some of the bigger credit funds that are out there, they've had to go and do larger and larger loans given their loan books are so big now, whereas we're in a space that is less competitive, I would say, from a pricing standpoint, and there's less risk associated with the projects and the sponsors. Most of our borrowers in that space are builder developers, as opposed to developers using third-party builders.
Yeah,
we know what they have on their books at the moment. We know that their focus is on our projects, and that's, I guess, for us, another level of risk mitigation.
No, well, appreciate that clarification. Now, you did mention that obviously, with the potential for interest rates to be falling, that you can simply just shift your valuations back to fixed rate loans. Do you think if interest rates fall, the rates offered under TCF will also fall on that back? And if not, are there other reasons other than just switching from flexible rates to fixed rates?
If you look, so we were previously writing debt in TOT, which is the total return fund. So we have done it in a listed environment as well, as I said, when rates were close to zero, and we were still averaging an IRR on most loans of north of 12%. Given the fact that it's a small cost in the scheme of a project, relative to the certainty of dealing with a relationship that they have used and know, that's where we're confident that our network can maintain those sorts of rates in their projects, given they obviously come back and like dealing with us and the certainties there. I think if you're out in the broker market and you're bidding on what's essentially a homogenous product, which is just capital, that's where you could see it coming under some pricing pressure. But as we've demonstrated in the past, we can maintain and switch to a fixed rate structure when rates move.
Well, thank you for that one. Now, obviously, you had a brief discussion just at the back of the presentation discussing which managers investors should be looking for. But obviously, you did also mention a whole lot of new funds starting up. Is there a particular reason in the market why this is occurring at this current standpoint?
I think people are chasing yield. There's obviously more, if you look across, I guess, the investor demand side of the equation, there's more people seeking yield going into retirement, and then are looking for alternatives to things like bank hybrids, which are starting to, or rumored to be, rolling off. That's where I think that at the same time, there's been a lack of capital for some of these projects around, and it's sort of worked that whilst there's demand for both the borrower product and the investor product, there's people that are emerging, and it's an unregulated sector. So it doesn't take much to set up shop, rent someone's AFSL and start a non-bank fund. That's where I think a lot of people need to be careful of the backgrounds and the time that they've been in the market when they're picking what loans they invest in. And also the transparency and understanding that, site finance might look like you're just lending against something, but how has that value been derived and what is that value in the current market?
Yeah, okay, thank you. Now, in the previous slide, you did kind of illustrate to investors that obviously you guys have a focus and a preference on senior loans as opposed to junior loans. Can you just explore why you have that focus on senior loans?
Yeah, because the senior really controls the capital stack. So if something was to go wrong, the junior, most often than not in that subordination deed, waits for the senior to do the enforcement. So they don't have the right to enforce in front of the senior. So you really are to some degree at the mercy of whatever the senior loan decides to do. And which obviously where we see, the loans that we do in that space, obviously do more due diligence around the borrower, the projects, our downside risk, but they're not loans in a, from a, I guess, portfolio concentration standpoint. We want to have TCF exposed more than 10% to. Obviously the returns are attractive, but also the returns are relative to the risk.
Yeah, of course, thank you. Now, one last one from me before I shift over to the participant questions. So obviously I've mentioned that, the sector you guys are operating in is fairly unregulated at the point. Should it be further regulated? If so, how do you feel about kind of regulation entering the sector probably in the next kind of 5 to 7 years?
Yeah, from our perspective, we think it should be regulated. I mean, we have obviously AFSL and all the other licenses and have been doing this for a long time. So we, from a protection of the underlying investor standpoint, would welcome regulation. Also, I would say would reduce the amount of capital that's in this space. Obviously, it's more beneficial for investors given it's less competitive from a borrower standpoint.
Okay, well, thank you. Now, just to some reticent questions. The first one I've got here is, given the insolvency and delinquency risks in the property development sector, what objective metrics does TCF have access to on its own borrowers? And what regular metrics data on borrower security can/will be communicated to investors? So
we have a full credit committee. So whenever we underwrite a loan, obviously go through that credit approval process. We have the financials and historic financials of any builder that we have or borrower that we're partnering with on a project. And then obviously run the Equifax Vita check on their actual credit records. Now, from an ongoing maintenance standpoint or monitoring standpoint, I should say, we use a system called Creditor Watch, which really we register the underlying borrower or parties that are stakeholders associated with a loan. And then whenever there's something that is considered adverse across any element of, I guess, the credit monitoring space, we're alerted to that. Now, that could be something as simple as directors changing or shareholders changing, resignations or winding up companies, etc. So we constantly monitor and have obviously PCG or project control group attendance, as well as that continual monitoring of borrowers' credit capacity and credit risk. Obviously a lot of that is confidential. So we haven't provided that in the past, and given we're under essentially most of the time under an NDA, we wouldn't be disclosing that to the public market and risk rating each of our underlying borrowers.
Understandable. Now, just on the topic of risks associated with the investments. Now, what do you guys see as the main dangers to the property market that TCF chooses to invest in?
There's obviously delivery risk, which is why we're very focused on that from a construction standpoint. If you look at what we focus our investments on, there's a lot of loans that we see, which I think people are hoping rates fall a lot further than they're likely going to. So
Yeah.
we're very conscious of any stress that there might be in the system, and then what people's view on value might be in 12 to 24 months' time, which is when our loan would be up for maturity. So I think at the moment we like residual stock, and we have a pipeline of that because we know what it costs to deliver a project in Sydney. We know that buffer that we have in front of us is comfortable in terms of a market correction, if there was one. We're obviously conscious of borrowers' ability to secure finance at the moment from the underlying mortgages. So I'd say the biggest risks in front of us are, there's a lot of volatility in the market, and some people probably think interest rates are going to go down lower than potentially they will. So it's just keeping an eye on that from the types of loans we write, which is why from an investment property standpoint, we're conscious of where cap rates are today and where cap rates might be in 12, 24 months' time, which is why we've only got one investment property loan in the underlying loan book at the moment.
Thank you for that one. Now, just to pivot here to a couple of other questions. I've got a participant that asked what your management fee on the projects are.
So management fees 85 basis points, which is on the fund. So yeah, regardless of what the loan type is, there's obviously an upfront fee that's paid to for securing the loan, so that's paid to the manager, but the actual management fee of the loan book itself and TCF is 85 basis points.
Okay, thank you for that one. Another one I've got here is your market cap is only 32 million. Is that large enough to have an adequate cost of capital as an ASX listed entity?
It is obviously on the smaller side. I'd say the flip side to being a larger fund is you can actually see and control what's in the underlying loan book at the moment. If you look at what our cost of funds are, we have a margin of 400 over cash. We're obviously exceeding that. We're conscious of exceeding that to attract investors, and we have been doing it for some time. So we think, yes, it's adequate for the size of, TCF is adequate being listed the way that it is, and we're focused on continuing to grow it. And there is a lot of investor support around it to see it grow.
Well, appreciate the clarification. Now, just moving to the last one for us today. We've got a participant that asked regarding the expectations of future cash flow flat returns, particularly when interest rates subside. Is there anything you can comment this to the market this morning?
I think, yeah, as I said, we obviously have a target return. So, and we have guidance in the market for this financial year. We'd like to think, given our track record in the past of the average interest rate we've received on loans, we'd like to think we can keep it above the target return, despite what happens with the underlying interest rates.
Brilliant. Well, James, that about wraps everything up for us. So thank you very much for your time and expertise. Before we finalise everything, is there anything you'd like to leave us with this morning?
No, if there's any questions on any of that, feel free to come through to investor.relations@360capital.com.au. Or if there's any investors that would like to be on the mailing list for our wholesale offering, feel free to send that your email details through to that email address, and we'll register you for any upcoming offers that we have.
Well, thank you.
Our bond advisor research, which is available on TCF, which is on our website.
Brilliant. Well, thank you very much for your time and expertise this morning, James. Really appreciate it. And thank you very much, ladies and gentlemen, for your time. Enjoy the rest of your day. Cheers.
Thanks, Ryan. Thanks, everyone, for joining.